Good morning, everyone, and thank you very much for joining me. This is the DAX Open with myself, Russell Shaw, Senior Market Specialist at FXCM. My email address is rshaw@fxcm.com, and today is Thursday, 6th of January 2022. Just going to bring up our high-risk investment warning. Whilst that's on screen, I'll just pop the link in for tomorrow's live trade for the NFP. So live trade on a live account. So just want to sort of emphasize the point that I will have an exposure to the trade, and I think that's everything. I don't know if I wanted to just say I've popped that into the chat. I beg your pardon. So if you aren't able to retrieve the registration, just send me an email. I'll put my I'll put the email address. You can just send me an email. I'll send you the registration link. I'm putting up the market commentaries disclaimer. I'll keep this on screen for a few moments. Also, just want to say I have cancelled the US Open for today and tomorrow. I do have to get out I'm writing a report on 2022 general forecast. So unfortunately, I'll do that today and tomorrow, and we will have the live trade tomorrow, but we won't have the US Open after that. All right, here's the references: FXCM MarketScope 2.0 and CNBC.com. So we'll start off with the CNBC morning European note, and it reads as follows. European market set to drop sharply at the open following US sell-off, and European stocks are expected to open sharply lower, and that's following losses stateside that saw the Dow Jones Industrials notching its first decline of 2022. European markets are set to follow the Asia-Pacific counterparts lower Thursday, following losses in the US during Wednesday's trading session. The declines come after minutes, and this is the important part. The declines come after minutes from the US Federal Reserve's December meeting, which showed officials are ready to aggressively dial back the central bank's pandemic-era easy monetary policy. And we touched on that yesterday when we spoke about the yields, right? Remember, we said, well, the yields are moving up. And then we said we've got to watch how the increase in yields is going to influence the valuation models. So if anybody missed that, it's on the Telegram, and you can just go back and watch it, or you can send me an email. But this is something that shouldn't surprise us, because this is really a conundrum that the market faces. How is the increase in rates going to affect valuation models? On the equity side, how's it going to affect demand for currencies, and also how's it going to affect real assets such as gold? This is all within the sphere of raising rates. Just to give you an idea with regards to gold, it is classified as or categorized as a safe haven. So is a bond. Okay, a bond, a US Treasury, a British gilt, German bund. Those are all safe havens. So if you want to go into a haven, you've got options. So let's say that in this particular example, you've got a choice between bonds and putting your money into gold. Well, if you are in a low interest rate environment, it doesn't really matter. It doesn't really matter. You'll go into one or the other because there's no real influence in terms of interest earned. But as soon as interest rates start going up, well, if you put your money into a bond, well, at least you're earning interest on that. Whereas if you put your money into gold, you're not. Okay, so in a low interest rate environment, the choice becomes, well, not really based on interest. It's kind of other factors. Now that interest rates are starting to move up, well, it's called opportunity cost. If you put your money into gold now as a haven, you're foregoing the interest that you could have earned in a bond. So you can see the interest rates now are having a ripple effect along the I guess we call it the risk frontier, starting from the left all the way to the high risk areas on the right. All right, let's carry on with the CNBC morning note. The Fed's plan to reduce the number of treasuries and mortgage-backed securities comes as it is already tapering bond purchase, as in set to hike interest rates after the taper concludes. And they have communicated 3 rate hikes for 2022, and that is subject to change. Depends how the market conditions develop. Major indexes on Wall Street fell sharply following the release of the minutes, with the S&P 500 dropping 1.94%, Dow falling 392 points, and the Nasdaq plunging 3.34%. Data releases in Europe include German industrial orders for November and Eurozone producer price for the same month. And yeah, okay, that's everything there. Let's bring up the main layout, and let's do some analysis on the DAX, understanding that the sentiment may be risk off today. Peter says you need to earn more than the interest rate, or you lose your purchasing power. I think that's by and large true. I've got to just think this through, Peter. The yield on a 10-year bond is what we call a nominal yield. So the nominal yield does have an adjustment for inflation. Okay. Again, I'm not sure if I've totally answered the question. I've got to think it through. I would suggest that the inflation adjustments have predominantly been made now. I don't think that there is much scope for higher inflation. That's my feel, again, subject to correction. And we know that the markets are forward-looking. So I think that the yield has adjusted for inflation. I don't think that it's adjusted for the real side of nominal yields, because that's what's going to be changing. So I think that's what we'll see. But theoretically, the yield should cover inflation risk. Now, I think there's an argument to be had there. For example, is the inflation adjustment taking into account non-volatile items, for example, which we are exposed to, right? Petrol prices, food prices, because theoretically, the core inflation, which policies are based off, strip out those volatile items. So I'm not sure if I've answered the question. I probably added more questions to it, but there's probably something there. Shadrach just saying or asking if we can look at euro and pound, and we certainly can. All right, let's take a look. Let's take a look at the weekly chart just to start. All right, so we've hit this resistance level. Okay, we've hit this resistance level, and that's the level that we're contending with at the moment. And there's the pullback. What's going to be interesting, I think, for this candle. Remember, this is a weekly candle. What happens if it ends the week like this? okay, because we're only on Thursday, right? So we've got another 2 trading sessions ahead of us. So this is, you guys know this is a Gravestone Doji, but forget about the really cool name, and let's understand the sentiment. So the sentiment of a Gravestone Doji is the market opens at the low, bulls take price all the way up to the high for the period. In this case, the period's a week. So we push up to the high for the week. At the high for the week, the bulls subsequently lose control, and the bears just then savage the price to the downside, and it ends flat. But the question is, well, who's in control at the end of the period? And on a candle that looks like this, it would be the bears. It's quite a bearish candlestick, but we'll just have to monitor how this closes at the end of the trade tomorrow. You can see that it's right at this resistance level, so there's still some work yet to be done. Having said that, we understand that there's a resistance level. The trend is up. Okay, so we've got the higher trough, higher peak. So any sort of pullback, let's say we get something like this, it's not the end of the world, because it sets up the next higher trough and potentially the next higher peak. We just don't want to be caught going long on a correction. So I think that's something that we just need to be aware of. If we go through to our oscillators, which is this tab here, you can see that our stochastic has crossed positively. And for me, that's really a focal point, because the question is now, do we get through to the upper levels, and do we hold these upper levels? That's really the hallmark of a strong trending technical chart. So we've got the bullish cross. Do we make it to 80 or not? That's the key question. Let's go down to the daily. All right, so the daily chart here is in zone 1. So it's in the bullish area. And this is going to make for a very interesting day, because it seems that the risk sentiment is negative. So given that, we need to make a decision. Well, what do we do? We're in the bullish area. So I think the best thing for us to do is just to fall back on first principles of the methodology, and that is as follows. We're just looking to exploit dips. Okay, so if there's a dip, that should kind of get us to sit upright and take notice, because if we can pick a correction, maybe it's something that we can make money off of. So we've got this zone 1. We've got an uptrend, okay, higher trough, higher peak. We do note that there seems to be a fair amount of resistance above us, and that brings us now to the hourly chart. So what do we do on the hourly chart? All right, so let's just clear this up. All right, so let's take a look at this in terms of, again, sort of first principles, and we'll do it as follows. 1, 2. So I'm taking sort of liberties to the upside. 1, 2, 2, 3. Okay, so is this the correct way to be looking at it? I'm not certain, but let's see if the price at the S1 support is actually going to bring in some buyers, because the market sold down. So maybe all the selling's been done, maybe the discounting's been done. If that is the case, well, let's cancel that. We've had a fairly decent pullback. It's gone all the way down to the 62% slash 76% level. So it's a fair pullback off of this impulse move here. So whilst the market perhaps expecting some bearishness, perhaps we take a slightly different approach and go, well, everyone else is thinking the market is looking bearish. We're going to just measure how bearish that actually is. So the way we're going to measure is that we're going to take a look at the stochastic. Okay, so if the stochastic cannot get out of the low 20 area, okay, if we can't get out of this low 20 area, then I think the sentiment remains risk off. And I think the sentiment remains risk off, and we should see further downside. However, if the stochastic, and you can see it has crossed, if it's crossed, can it get out of the 20 area? And if it can get out of the 20 area, can it make its way up to the 80 area? In other words, this could be a dip in an uptrend that's worth keeping an eye on. So let's just see if we get, so we've got one trigger, we don't have the second trigger, okay? So if we don't get two triggers, not much we can do. It's going to keep us out of this type of trouble. Even if we get the two triggers, you still need to use stop losses, and you still need to use money management, because there's no guarantees here. But the idea is, if we get those triggers, does the stochastic make its way through to 80? And if it makes its way through to 80, does it hold? And if it does, well, this might actually be something that's worth, keeping an eye on. Even yesterday's morning note, as I recall, was bearish, but we had a really nice start to the day. It really was a good day on the DAX, all the way until the minutes. As soon as the minutes were released, that's where the sell down took place, right? It was a good day until then. The minutes, the FOMC minutes. All right, so I think just keep an eye on these triggers, and then of course the stochastic. Peter's just writing the German factory orders came in as strong. Okay, the cash market's going to open in the next 2 minutes. I would also suggest the first hour is going to be very difficult. If you put in a position that first hour, it's almost a gamble, because the limit orders will get triggered. The algos will kick in, and we're not quite sure which way they're going to take the markets, and we're not quite sure if they initially take the market in one direction and then get faded and we start moving in the other direction. So just bear in mind that I think it's probably prudent, especially after sort of the market got a bit spooked by the Federal Open Market Committee's minutes. So we'll just keep an eye on that. Nevertheless, we'll just consider perhaps a contrarian type of opinion here. If there's any questions, type those through. The cash market's going to open in less than a minute. We'll come back to that, but between now and then, let's just do euro and pound. So I did take a look at the euro this morning, Shadrach. It's still, for me, it's still in this zone 2. So my gut feel, shall I say, is that the euro does decline. The reason I think it declines is because of the monetary policy differences between the ECB and the Fed. I think that given that, there's going to be pressure ultimately on the euro. But I just wanted to get into this zone 3 here. We know on the weekly chart, the trend is down. I just need more certainty, less ambiguity between the daily and the weekly. So I looked at it this morning. No change up between today and yesterday. So I think the conclusion, my conclusion, okay, subject to correction, is that just a little bit more needs to be done on the daily chart there. And if we go through to the cable, okay, so again, not the easiest chart to read. And the reason that I think it's difficult is because the longer term trend is actually down. We've got a series of lower peaks, lower troughs, lower peaks, lower troughs. The issue now is, well, what are we doing right now? See, we're not trading on the left side of the chart, we're trading on the right side of the chart. And the question is this LT to LP question mark, is that a new bullish trend that's developing? And the answer to that, honestly, is nobody knows. The trend at the moment is down. In other words, there is, in my estimate, a fair amount of suspicion that this is actually a bullish move here. But I don't know, right? Because the BOE is also swiveling to a contractionary policy. They've already lifted rates from 0.1 to 0.25. And if you take a look at the daily, we're in zone 1. So we've got this conundrum: weekly downtrend, daily strength. What do we do? And I think that is a difficult question to answer. My personal analysis of it is that I'm not comfortable. I'm not comfortable with this leg here. I think that this is a suckers rally. It could be wrong, but to me it's a suckers rally. And the problem with these suckers rallies is that's where the damage is done, is where it suckers you in, because you think that the downtrend is now actually become an uptrend, and then the next thing we get punished as the market pushes to the downside. So again, Shadrach, not something that is particularly clear to me. And again, both central banks are hawkish. I think that ultimately my feel is the Fed just tips the scales there, but it's probably worth just letting the market give us a little bit more evidence there. I hope that helps, Shadrach. I'm not sure that I provided any sort of clarity, but I guess the reason for that is because they're ambiguous situations. Let's just go back to the DAX, see how it opened on the day. Sorry, on the morning. All right, so you can see that does seem to be a little bit of strength coming in. Again, I'll just emphasize the point is this could be a lot of algos kicking in, a lot of limit orders kicking in. It's probably worth just holding back for the time being and seeing if we get that those triggers. All right, any other questions, please go ahead and type those in. Any other questions, please go ahead and type those in. Just a reminder, the link for the live trade is in the chat, and we won't be doing the US webinars today or tomorrow, but hopefully we'll get back to those from next week. All right, nothing coming in, so I'm going to conclude here. Thank you very much for joining me this morning, guys. Much appreciated, and speak to you all soon.